Let me begin by kind of a historical perspective, and I was intrigued by some of the conversation yesterday about the 1980s in terms of experiences and so forth. This is a slide that simply shows you agricultural prices and so forth. And if you look back at that slide, you'll notice that in the early 70s, we had a fairly significant increase in ag prices, that carried us into the mid-80s and so forth. And so we've gone through a very similar type of thing now in agriculture. We've got another level of prices now that we're looking at. And the problem for agriculture is once you go through one of those super cycles, how do you realign yourself to the new realities once you come out of those super cycles? And that's really what we experienced in the 80s and so forth. We came off that high with regard to that commodity price run-up. And then everybody had to kind of readjust their expectations, that the reality wasn't that we were going to have $15 soybeans and $5 corn. That wasn't going to last forever. But that transition to that lower price and then the traditional volatility that's always in agriculture began to play out in discussions that you heard in the mid-'80s. I don't think that we're about to enter into a period as traumatic as that one, but it's still going to be a fairly high stress level as we talk about, whatever industry you want to talk about. It was $12 soybeans and now it's $8 soybeans. That really does have a big impact on the psyche and forces significant adjustments in both households and farm operations and so forth. So that's the transition that we're looking at going forward. It's been a very dynamic period. If you look at that slide, you can see the rapid run-up in commodity prices as a result of really two events: ethanol, the biofuels industry, and then the emergence of China and the emerging markets drove up prices very rapidly. Agriculture really weathered the recession fairly well. And a big part of that was China wasn't impacted very much by the financial crisis. So one of our big customers was still buying during that period of time. So you see ag prices did take a dip there around 2009 during Lehman Brothers, but it bounced back fairly rapidly and so forth. But you can see now we're in a fairly consistent decline in these prices. We're beginning to get into the range where I think we're going to be talking about these are kind of the new price norms, if you will. But there's still a lot of adjustment behind that because we've had such a dramatic decline. Business practices have to realign. Producers and households have to think about maybe they can't take 3 vacations this year. So realigning household expectations with farm expectations is a real challenge when you go through these kind of adjustments. And I'll talk later about some of the other things going on with regard to technology in terms of agriculture. The other thing that emerged from all of this was a greater dependence on the export markets. So when we came out of the Lehman Brothers, when we came out of this super cycle, we were left with an agriculture that was much more dependent on the export market than it was before. And one of the key industries, if you will, in the Southeast is the hog industry. We used to only export about 2% of our production on pork. We're now exporting 20% of our production. So now you're talking about a different kind of volatility that's coming from outside the traditional mainstream. That's changed the dynamics in the market. And you can see in most of these categories, you've got very high dependence on the export markets. And if you look at soybeans, about half of our soybeans that we export historically go to China. So our markets are China, Mexico, and Canada. Those are the 3 big markets. And unfortunately for agriculture, those are the 3 countries we seem to be in kind of constant turmoil with at this point in time, with some hope that perhaps we'll calm down with regard to the NAFTA countries. But certainly the China is going to continue to be an issue. And so all these commodity markets are simply on hold to some degree, putting more pressure on prices going forward. When you look globally, you find a great deal of turmoil still out there. So this slide is just a reminder to everybody that when you look around the world today, there are no shortage of issues that are going to impact the export markets for agricultural products, whether you're talking about China and the U.S., whether you're talking about South Korea, North Korea, whether you're talking about Syria, Iran, turmoil in Europe, or as I mentioned, the issues with regard to the NAFTA countries. So from a producer standpoint, looking at the marketplace, what they see is a very volatile marketplace subject to a lot of wild cards that they have no control over. And I think that's really one of the challenges for agriculture, is how to absorb these pressures in terms of price expectations. You're seeing a lot more discussion with regard to the farm community in terms of marketing strategies, trying to help producers understand their marketing strategies going into this kind of volatility. There are also other issues that are out there in terms of driving these global markets. Oil prices obviously play a role in many of the rural communities, whether you're in the Bakken up in the north or you're in the south. Energy prices have a great deal of impact on agriculture, and certainly because of biofuels, it drives a lot with regard to that industry. So oil price volatility, and certainly the changes in central bank policy. So, interest rates have been on a kind of 11-year cycle of zero interest rates. And I think that's one of the things when I talk to young farm audiences and so forth, they really have never experienced a rise in interest rates. If they've been in agriculture for 10 years and they've talked to their banker, the banker has never had a sit down with them to talk about, what if your interest rates are 1 or 2% higher than they were the last time you came in. And most of them have been borrowing on the short end of the curve. Now we're seeing a change in that transition, and I think that begins to put more pressure on agriculture as well. This slide just shows you where we've been on interest rates. We have been at zero interest rates now entering our 11th year. We have 22 countries that have negative interest rates. And from an economist standpoint, trying to explain to people how you have a negative interest rate has always been a challenge and so forth. And basically what it says is the central bank authorities, if you want to deposit your money in the Federal Reserve, not in the U.S. Federal Reserve, in these central banks, you have to pay them to put your money there. And this is really what the central banks are trying to do, is to put this money out into the economy. They don't want it to be parked at the central bank. They really want it out generating business and so forth. So that's what the negative interest rates are all about. But that interest rate regime that you see changing has a lot of impacts on business decisions and profitability. When you get into low price scenarios and you begin to sit down with farmers and talk about where we're going, this will be the first period of time where we're going to be talking about interest rates that may be 2% higher than they were just a year or so ago. And the dynamics of that are vastly different. Now, I will tell you that in the 1980s, for those of you who may have not followed the 1980s, that was a period of time when interest rates were 15%. So much different farm economy to deal with, much easier to work challenging farmer in terms of their loan portfolio at 2 or 3% or 4% than it is at 18% or 15%. So that's why I say I think the transition will be less dramatic than it was in the mid-'80s, but it will be no less painful for some segments of agriculture, I think, as we go forward. And the dollar, of course, the currencies have a lot to do with this as well. When the dollar gets stronger, we're less competitive globally. We're really makes us harder to hold our market share if the dollar's stronger. And if you looked at that last slide and you ask, well, where would I park my money at this point in time? If you look at those interest rates, you'll park your money in the U.S. or in U.S. dollars. So that's why you're seeing the rise in the currency. It really makes it more difficult for us to be competitive on a global basis. It obviously reduces the cost of imports, but from an export standpoint and for agriculture, it really means that we're raising the prices to our customers even if we're holding prices steady. So that's going to continue to be a challenge, I think, as long as the central banks, where the U.S. Federal Reserve is the only central bank raising interest rates relative to the rest of the world, that's going to continue to put upward pressure on the dollar, really make it much more difficult to rebuild these export markets going forward. The global economy, at this point in time, I remain kind of cautiously optimistic, but there's no shortage of issues. In that first slide that we talked about in terms of just rolling around the world and seeing where we're at with various issues, you've seen the headlines on Brexit. So, Europe is having a problem with the UK leaving the European Union, negotiating an agreement. So it means Europe is going to be in constant turmoil. You have issues in pretty much every part of the world at this point in time. So I'm cautiously optimistic that the world economy is still pretty steady at this point in time, and that's important for agriculture going forward. We really need the U.S. economy or the global economy to grow around 3.5%. That's about where we're at this point in time. Remember that the world has changed a great deal over the last decade. If you look at world economic growth from 1970 to 2000, the advanced economies accounted for 56% of world growth. Now they account for about a third of world growth. So world economic growth now is driven by the emerging markets outside the advanced economies. And that's really kind of important for agriculture because those are our growth markets going forward. But they are obviously much more volatile than the advanced economies. So this interjects a certain amount of inherent volatility in the U.S. sector. The U.S. economy, of course, is a big part of it. As I say, we export 20–30% of what we produce in agriculture, but we sell the other balance in the domestic economy. So it's very important. Where is the U.S. economy going? What is it creating in terms of job opportunities? When I talk about rural America and we talk about ag, we also have to talk about how is the rural mainstream economy doing in these rural areas and so forth. And the fortunate thing is, over the last year or so, we've had a pretty strong economic picture. Some of that, I think, is going to moderate as we go into 2019, further into 2019 and 2020. So I think we face some bigger economic challenges from the domestic side as we get further in towards 2020 going forward. We may have been through the best economic period over this past year, so the challenges will probably get a little bigger for Main Street, rural America, as we go forward. Again, a lot of transitions in Washington, and the other advice I give to a lot of groups I talk to is to spend less time on CNN and Fox. You're probably better off not to watch those at this point in time. That simply adds to your sense of frustration, irrespective of your party and so forth. It is a little bit unsettling that is one of the challenges going forward. This divide in the country politically and economically and so forth creates a lot of these challenges, I think, going forward. But this economy has been going very well for some period of time. This is a slide that shows business cycles. And the business cycle for an economist, the economy reaches a peak, it goes into a recession, and then it recovers. So we talk about recessions, and then we talk about expansions. So that would make a business cycle. And you can see this just tracks historically what business cycles have looked like in the U.S. And you'll notice that the one we're in now is now the longest business cycle in U.S. history. So you are part of the longest business cycle in U.S. history, but it's also one of the very modest with regard to expansion. So if you look at historically at U.S. expansions and business cycles, you'll notice at the end of these business cycles, the point at which they finally do go back into a recession, the economy is significantly bigger than when it started prior to the recession. So typically 40–35% bigger. This time around, we're only about 20% bigger. So it's been a very subdued economic path going forward. That has led into some of the challenges that are going forward. Some of this is about transitions in the economy going forward. I'm optimistic that we still have momentum that will carry us into 2019. I begin to put some flags up when we get to 2020 for a lot of reasons and so forth. But I think the underlying economy is very strong. The challenge in the underlying economy is that we've had such a technology transfer going on that we're still leaving a lot of people behind in terms of the transition. If you look at all of your outlets, your commercial outlets and so forth, the one thing that you see is an attempt to reduce the amount of commitment to labor. So if you go into a fast food restaurant now, I was in one the other day, and I looked around for somebody, and they just pointed me to a screen to put in my order. If I go to a Sam's Club, they just hand me a little wand that I just click on everything as I go out the door and so forth. So we're seeing technology eliminate jobs. We're seeing jobs are becoming much more technical, so that the technical capability you need to compete in a knowledge-based economy is important. If you look at this economy, prior to the recession, we were building at a rate of 2 million houses per month at an annual rate. We're now doing half that. So all that labor that was in the housing market is now not in the housing market. We only need about half or less of those people, and the skill set that they have doesn't match up with this knowledge-based economy. And that's really where we're seeing the biggest economic transitions and biggest challenges. So for agriculture, we're still looking at a pretty solid consumer. I think that's important for the animal protein and dairy side, that the consumer remains strong. And that will carry the economy, I think, into most of 2019 and into 2020. And that's the plus side, I think, for agriculture, particularly, as I say, on the animal protein and dairy side, and on the biofuel side in terms of demand for energy. But I think we can see that there's going to be more economic stress the further we get into 2020 in terms of transitions. The consumer looks extremely strong, and so when I'll talk in a little bit about the animal protein and dairy side. This is a big key for sustaining these price levels. The fact that consumers have got their debt-to-income numbers down very dramatically, and their net worth is at record levels. So this is really what's driving this U.S. economy at this point in time. It's what supports a lot of the major segments of agriculture. Business investment is the other thing. The corporate tax cuts, the infusion of fiscal stimulus, all of these things are generating kind of support for the economy that I think is probably going to wane as we get into 2020. And I think that's where we're going to see more and more challenges on Main Street side as opposed to just the ag side. Obviously, we'll have to watch and see what happens with regard to legislative initiatives. I think we'll probably get a farm bill either this week or next week. That will remove some uncertainty with regard to funding. There'll still be some issues with regard to some of the market facilitation programs that were designed around the U.S.-China dispute. But I think by and large, we're going to be looking at kind of a run to the end here, if you will, with regard to Congress, the lame duck session, trying to do tax extenders, which are important for the biodiesel industry in particular. But I think a farm bill looks like it's very likely to be in position for next year going forward. And then we'll see where the agenda takes us. Obviously, we've got a different Congress this next session of the 116th Congress, with the Democrats in control of the House, Republicans in control of the Senate. So I think the best advice I can give you is the political turmoil is not over with. It's going to continue. And it will be a distraction, I think, for virtually every sector of the economy, I think, going forward. I just don't think that that's likely to change anytime soon as we run into 2020. So overall in agriculture, then, we look at a global economy in a bit of turmoil, a domestic economy that really is fairly resilient at this point in time. So there's some reason for some cautious optimism for agriculture. But that doesn't mean that we're kind of out of the woods, so to speak, in terms of the challenges that are out there. If you look at this slide, it really shows carryover inventories in agriculture for the major commodities. And what you notice from this slide is that virtually every commodity has a fairly large global supply in front of it. So much of agriculture today, what it's looking at is we've got large global supplies of commodities, and we've got a global economy that's really not going at 100% with a lot of turmoil with regard to geopolitical issues and with regard to social issues. So if you look in France and you look at the turmoil that's going on there, if you look at Brexit, virtually all of the advanced economies are struggling with the same problems and so forth. So this is the uncertainty that lays behind a lot of these numbers. When you have uncertainty on the demand side, you have large supplies. On the supply side, this really keeps downward pressure on prices. So that there's I think, limited downside risk for most of these commodities, but there also is limited upside potential. So really, what it really says is producers are probably going to have to adjust to these price levels and make adjustments internally, because the likelihood that we're going to enter into another super cycle on commodities is very limited. So I think what we're talking about is producers and their lenders making some tough decisions now about how we're going to run these operations and where we're going next, what kind of scale are we going to need to be competitive, because these inventories are fairly large. Well, the only exception would be cotton, where you're beginning to see some drawdown in inventory, and we're going to see some acreage adjustments as a result of that. Global markets on the demand side, if you look at global trade in commodities, still pretty steady at this point in time. You see the sharp run up during the super cycle. We're starting to see some plateauing with regard to the demand side. And one of the problems for agriculture has always been, when things are good, the first thing you want to do is produce more. And so whether you're in the U.S. agriculture or you're international agriculture, the first thing you do when you see higher prices is start producing more. So when demand starts to plateau out and you're still producing more, that's when you get these kind of price pressures and so forth. And so now we'll have to wait for the demand side to kind of catch up. And given the turmoil that you see on a global basis, one cannot expect that you're going to see a sudden surge in commodity demand. But what you can be fairly confident with regard to U.S. farmers is they're going to figure out how to produce more with less. Whether it's in the seed side or whether it's in the technology side, they're going to figure out how they can produce more and get their per unit costs down and so forth. And that really is going to continue to be a challenge, I think, for agriculture. You're well aware of the prices. If you look at all these prices, what you see is that spike during the super cycle in commodities, and then you see a fairly dramatic decline in all these prices over the last few years. To what I think is probably becoming more of a kind of a normal level of prices for the foreseeable future, because I don't see on that horizon that spike other than Mother Nature. Now, Mother Nature can throw a wild card in there for you, as it has in some parts of this country for certain commodities and so forth. But by and large, barring that major shortfall someplace, this is the tenor of where we're going to stay from a lending standpoint. This is the approach we take to it when we sit down with producers or with agribusiness. We have to look at it in terms of the realism of what's out there in terms of the commodity markets. We are going to see a lot of shifts in acreage. I think when soybeans start heading towards $8, and if you're in North Dakota, it's probably starting to see the $7 mark and so forth. You're going to see some shifts in acreages, more cotton, perhaps a little more wheat. It's rare to see a producer not put his land into something. So there are going to be some adjustments in acreages for 2019 and so forth going forward that may do some rebalancing, but again, not enough to really kind of change the underlying course. Wheat market has been one of the more challenging areas. That's probably not a big commodity down in this part of the country, but I can tell you in other parts of the country, we have reached a point where our planted acres on wheat is really back to the 1890s. We're really getting out of the business of producing wheat in this country. We're down to kind of a basic level in terms of areas of the country that really have advantages with regard to wheat production, to maybe have limited opportunities and so forth. So you can see the big driver for this year in terms of rebounding wheat prices was the decline in production in the former Soviet Union. So in many cases, a lot of these pricing opportunities that present themselves in the form of shortfalls someplace else in the world. So in this case, the countries of the former Soviet Union, their production was off this year. They were not able to push their exports higher. That created a window of opportunity for the U.S. wheat to move into the global market. And so we got some recovery in wheat prices as a result of that. My expectation is that you're not going to get those shortfalls every year out of the former Soviet Union. Wheat is going to continue to be a challenging commodity. And again, it fits into rotations, it fits into the cow-calf operations and so forth. But as far as a basic commodity, we have no unique advantage in the global marketplace with regard to wheat production. World wheat yields are about as good as U.S. wheat yields. So we have no real decided advantage with regard to wheat relative to the global economy. And you can see from this slide, our wheat stocks have been coming down in the U.S. The green bars are inventories. You see production in use, and that production line has been coming down pretty dramatically as we've gone. Acreage has shifted out of wheat to other commodities. And my expectation is that's probably a trend that will continue. We'll probably stay at this basic level of wheat production for the foreseeable future. That acreage is probably going to stay out of wheat in other commodities or go into some kind of conservation programs as we go forward. On the corn side, it's a little bit more dramatic. There's a little bit more optimism on the corn side with regard to price potential, simply because you'll notice that inventory number is coming down. So we're harvesting large crops of corn, but we're still seeing a pretty strong demand side out there. The problem, of course, is China is one of the big markets that everybody's expecting. So the resolution of the China-U.S. Trade dispute would have a significant impact on expectations with regard to agricultural commodity exports. And I think that's one of the big problems at this point in time. It's hard to be optimistic if China is not on the play as a major player taking U.S. agricultural exports. And so everybody's a little bit tentative in terms of, even if we work out an agreement, even if we come to some agreement with regard to intellectual property and so forth, what have we done to that potential marketplace for the future in terms of growth? Because as I tell most ag audiences and producers, the size of the U.S. agriculture will be a function of the export market. We produce more than enough for the domestic market. It's that 20 or 30% that has to go into the export market that will determine the size of the industry as we go forward, whether you're talking about animal protein and dairy or if you're talking about the grain side. The big challenge for the coarse grains or corn market, you see that black line, that's really ethanol. When we talk about the transition in agriculture, when we decided to divert our corn into the ethanol industry, we made a significant commitment with regard to how much corn is going to go into ethanol production. And you'll see that the export numbers dropped off fairly sharply. One of the unintended consequences of that decision was we signaled to the rest of the world, you may want to start producing more corn for the export market because we're not going to have it, we're going to be using it for ethanol. So the result was Brazil, countries of the former Soviet Union, suddenly became major producers of coarse grains. So now we have a problem in the sense that the ethanol industry has matured. It's not going to grow too much faster under the current policies, and now we want the export market to grow. And the problem now, we have more competition there. So when we started into the ethanol industry, 2005, the U.S. had 56% of the world market in terms of corn. Today we have about 35%, about a third of the market. And the reason is we diverted our supplies into ethanol. The rest of the world expanded production. They got into the export business, and it's not likely that they're going to exit that business. So that will be a challenge as we go forward. But right now, the balance with regard to the corn side of the market is still pretty tight. So I'm optimistic that you could see some improvement in corn prices, but again, somewhat capped by the lack of potential in terms of market growth. Soybeans has been the market that's derived the most attention recently, in large part because 50% of our soybeans go to China. And obviously China is politically smart enough to know that if you get in a trade dispute with the U.S., the first thing you want to do is go after that political base for that administration, and that happens to be the heartland of the country, and it happens to be soybeans. So you've seen a very dramatic drop with regard to soybean prices and expectations. It's compounded by the fact that we had record crops in the U.S., record crops in South America. So at the time we were talking about record global production, we were talking about a major buyer of soybeans beginning to level off with regard to their consumption. And that really has led to the big challenge. You can see this slide shows you carryover stocks of soybeans, and you can see that blue bar has shifted dramatically higher in the last year. So we now have substantial carryovers of soybeans that are going to have to be dealt with. They're going to have to be worked off over the next year or so going forward. And unfortunately for the U.S., what it meant was that China was going to buy everything that Brazil could produce. And around the world, we could find some other markets, but most of that increase in inventory is in the U.S. So if you look at the U.S. inventories of soybeans, you can see now that we're talking about almost 1 billion bushels carryover of soybeans. And you can see relative to history, we've never seen these kind of numbers in terms of carryovers for soybeans. So that segment of the market, that segments of the industry, which had been attracting more and more acreage, because what was happening, China was a consistent buyer. We were shifting acreage out of other commodities into soybeans, and now all of a sudden we're overwhelmed in terms of the inventory of soybeans. Now, hopefully we'll see some increased purchases, but now we're talking about a catch-up, because now we have 25% of what we need in terms of soybeans we already have in inventory before we start the year. So this is going to take some time to work out in terms of going forward. This is China. You can see that red line, as I talked about, and very often I've had conversations with producers. I always worry about single country commodities. When your commodity, when 50% of your product goes to one country, you have an exposure that you have to recognize, and producers have to recognize the potential for volatility. We've been riding that red line up, and it was always a signal. If indeed China were to slow down their purchases, we could have a dramatic overswing in terms of commodity prices in the soybean market, and that's exactly what happened. Now, it was precipitated by a trade war. It was not precipitated by an economic decision on the part of the Chinese to suddenly slow down their consumption and so forth. But the net result is the same as far as soybean producers go. So this is not going to resolve itself in just 1 year. We're obviously going to probably plant less soybeans next year than we did this previous year, but not enough really to kind of change the dynamics for a while. And certainly until we work out arrangements with regard to China, it's going to remain a soft market, and we're also going to have to decide what have we done to our supply chains going forward, because there is this question of, are we now the reliable supplier we were prior to this tariff issue? And I think the rest of the world's looking at us and saying, well, we had agreements, but we seem to have abrogated those agreements in terms of imposing tariffs and so forth. That can change the psychology. If I'm a buyer of these commodities, I might want to diversify my sources of supply. I might want to change my supply chains a bit. That could have long-term implications for agriculture going forward. You can see the inventory numbers on soybeans. We're simply produced much more than we need. Even if we scale back a bit, we're still probably going to be producing more soybeans than we need for the foreseeable future. Again, unless Mother Nature steps in and gives us a hand, I think that pressure is going to stay there. Cotton is the one bright spot. That's a bright spot for this part of the country, I know, in terms of pricing. Producers have done very well over this past year if they were able to avoid damages from weather. So, I mean, this is this is kind of when you go and talk to farm groups and you talk about prices and you talk about, well, you're getting 70-some cents, there's always a subgroup within that audience that looks at you and said, yeah, if you had something to sell. And that's part of agriculture and so forth. But I think it's a part that needs to be recognized fairly clearly, that these averages that we talk about for agriculture is extremely diverse across this country. And you have pockets of problems that are unique to those areas and so forth. And so it's one of the real challenges. I know when I was in USDA and when I was with the National Council of Farmer Cooperatives, one of the challenges that you had was if you go to talk to an audience in Mississippi, that's different than going to talk to an audience in Washington State or California, particularly California. If you go to California and talk to that farm group, and then you go to Mississippi and talk to that farm group, you have a real challenge in terms of realigning your rhetoric for what's going on. And so I think that's one of the challenges for groups like yourself. If you're going to represent 17 or 18 states, you've got 17 or 18 farm cultures that you have to deal with. And so one thing doesn't fit for everybody here in terms of the transitions we're talking about. Most of the expectations on prices for next year really are steady as you go at this point in time. I think that's probably the best you can hope for. Again, unless Mother Nature intervenes, we're not talking about any particular commodity really breaking out at this point in time. Most of them are steady as you go. And I'll talk in a moment the challenge that presents from a crop standpoint. From the animal protein and dairy side, a lot of transitions going on. The biggest transition was probably in the cattle industry. It wasn't that many years ago when we looked at the cattle inventory, and it was the lowest since 1952. So, you know, when we had those high grain prices, when we had those droughts in Texas and so forth, we liquidated the cattle inventory very aggressively. And you can see that red line dropped very sharply. As I say, it really went back to the levels of the early 1950s. You can see now that we've rebuilt that cattle inventory very aggressively over the last 4 or 5 years, and we're now full out in terms of beef production. We're producing, you know, year-on-year increases in beef production very steadily at this point in time. You can see it in the meat case. You can see it in the prices that have come down dramatically. In 2014, that was a record level for all animal protein and dairy prices. Since then, those prices have slid down very dramatically and so forth. So that's been the major transition. The hog industry has really expanded very rapidly. A lot of that has to do with that 20% market share, or 20% going into the global market. So you can see the hog industry has expanded very rapidly. Their challenge is, if that export market is not there, 20% of their production is going back into the domestic meat case. And we've seen some of that already. I think the expectation is that the hog industry is going to stay under pressure going forward unless we can find some recovery, you know, in the export market. These are just numbers on how much we've been expanding production. And you know, at the peak period of prices in the animal protein side, we were not increasing meat production in this country at all. Now we're increasing meat production in this country 2, 3, 4% per year. And the reality is the domestic economy cannot absorb that pace of increase. So when you disrupt the export markets, particularly to Mexico and to China, you're putting real pressure on that animal protein sector and dairy sector going forward, and that's going to continue to be an issue. And I think that's one of the things when you look at agriculture, you talk to farmers, one of the things they have the hardest time getting their arms around is that they have no control over this international market, but this international market is driving their business. And that's a real challenge from their standpoint in terms of going on. As I mentioned, export markets have been the big key. If we don't grow these export markets, this product goes in the domestic meat case. If it goes in the domestic meat case, consumer's going to be right there. They're going to buy a pound of meat, and they're really kind of indifferent in terms of whether it's broilers or whether it's pork or whether it's beef. There's a certain cachet with regard to beef, but everything else, it's a matter of what's the price per pound, what's on special, et cetera, going forward. And there's a limit to the potential expansion in the marketplace. These baby boomers like myself are retiring pretty quickly. We're not consuming that 16-ounce steak anymore. We stopped doing that some years ago. But there is this transition with regard to consumption patterns that are also going to impact agriculture going forward. The dairy side, you can see the peak in dairy exports really was back in 2014, and since then, if you look at the value of dairy exports, it's come off very dramatically. A lot of competition internationally, and that's why I go back to the U.S. dollar. If the dollar's high, it really gives our competitors a real advantage in the marketplace. The Europeans have taken significant advantage of that in terms of taking market share away from us. Again, when you look at prices for next year, it's pretty much steady as you go. A lot of pressure in the pork side because of the expansion on production. but we're just putting a lot of meat in the meat case, and if it doesn't go overseas, it will depress these prices further and so forth. And we're probably not going to see further declines in cost side for the animal protein and dairy side. All of these industries will be looking at new technology as well. You may have seen a lot of discussion about robotics in the dairy industry. If you look across every one of these industries, they're all doing the same thing. How do I reduce my labor commitment? How do I get more pounds per animal with genetics? All of this is part of that transition that's going on in agriculture at this point in time. Overall in agriculture, this is a slide simply shows you livestock prices, crop prices, and prices paid. And this kind of illustrates the dilemma for agriculture at this point in time. You can see the fairly sharp adjustments in commodity prices, but note that prices paid line has really kind of stayed steady and so forth. It really has not aligned itself very well with the new realities in terms of commodity prices. Now, we've seen some adjustments in fertilizer prices. Those prices actually are starting to rise again. But we've seen very little adjustment in rental rates, very little adjustments in seed costs, and I think for producers in general, they're getting a lot of cost pressure here in terms of how do I get my costs down in this environment where I'm not seeing input costs kind of decline with the commodity price levels. And that's really kind of where the challenge is, I think, as we go forward for agriculture, because I don't think you're going to see a big rebound in commodity prices. The question is, how do we adjust our costs to this new reality? And if the input prices are not coming down, I've got to get more efficient. I've got to do something different. I've got to get to a different level of technology, and a lot of that technology really requires scale. And so, my expectations, we're going to continue to see consolidation virtually throughout the food and ag chain. Because they're going to have to get more and more efficient going forward, puts real pressure on small producers in terms of trying to, how do I use this new technology, which is fairly expensive to adopt, and really it works better over larger land areas going forward. So am I going to be able to find some other farmers to work with me to adapt to that technology? I'm going to have to do business somewhat differently than what I've been doing it going forward. This is the slide that I have the most trouble with non-farm audiences. Non-farm audiences only remember that 2010, 2015 period where net cash income was 70% higher than the previous decade. So we went 5 or 6 years with the net cash income to agriculture averaging 70% above the previous decade. Phenomenal period. When I talk with producers, they understand that's where God intended prices and income to be. And so they're having trouble getting their arms around the fact that we've now dropped back to where we were in the previous decades in terms of net cash income. And that's the big challenge, I think, for many of them. At this point, we've not reached a point where we're seeing adjustments in land values, and that really is kind of one of the next kind of domino to fall, if you will, with regard to agriculture. The balance sheet of agriculture, if you want to go back and think about the 1980s, during that period of time, that red line and that green line went up together. So the farmers' assets were going up, and their debt level was going up right with it. So that was a period of time when lenders were very accommodative. If your land values are going up, we can lend you more. We're more than happy to lend you more. And so debt levels went up with asset values. This time around, much more conservative with regard to debt levels, so we don't have the leverage that we had in the 80s and so forth. And that's the good news. Now, that doesn't say that you don't have leverage, particularly in areas where maybe you've had natural disasters and so forth, but producers don't have that. This is a little bit troubling in terms of it shows you asset values, which are really land, and net cash income. And you'll notice that these income levels are not nearly consistent with these asset values. So that black line is this, if you will, land values. The red line is cash flow to agriculture. And what it says is we've got a big gap here between these asset valuations and these cash flow numbers and so forth. And as I mentioned to you, we have not seen adjustments in land values. So that's one thing to watch for over the next couple of years. If you're going to get more stress in agriculture, it's going to come from beginning to see changes in land values going forward, because that's our principal asset that they're going to be dealing with. And it'll be very diverse across the country. This is debt service, debt interest. Farmers are taking on more debt. That's our answer to lower prices. I want to produce more and I need more debt in order to be able to do it. And that's going to continue to ramp up the stress, if you will, going forward. The working capital is being drawn down pretty dramatically. This is pretty consistent. When a producer's working capital gets drawn down, they start going to debt. And so now we're seeing much more debt. So we're going to have to watch the land value side. That may be more of a problem in the upper Midwest. If you look at land values from 2010 to 2018, and you go up to North Dakota, it's about 135% increase in land values. Part of that's energy, shale oil and so forth. But notice in Georgia, it's only up about 1%. So perhaps you don't have as much exposure in those states as you do in those Midwest states, but it is the thing to watch. The last thing, and this is the one I typically end with farm audiences, is that at the end of the day, the world is going to be resource challenged. So I think when you look around the world, in a more normal world from a geopolitical standpoint, we'd be talking about the potential for recovering these commodity prices fairly quickly, rising emerging markets, rising middle class. All of these things promise more opportunities for agriculture and so forth. But we've got some significant transitions ahead of us. It's not just in prices, it's in technology. You talk about mega mergers, and as I mentioned, this whole transition in technology, AI, is going to transform agriculture pretty dramatically, I think, over the next 10 years and so forth. So it's an exciting period, but at the end of the day, there are opportunities on the horizon. And that's really kind of the message I kind of try to stay with. And I think this was a comment that was made yesterday. When you're talking with producers under stress, what they want to see is an opportunity going forward. And I think that opportunity is there, but we've got a significant transition to get there at this point in time. Let me stop there. I'm going to be out of time. I don't know if we're going to do any questions or not, but I'd be happy to.
We might have time for two quick ones.
Two quick questions or rebuttal if somebody has a speech they want to make.
Terry, I'm going to say something heretical and you can correct me. I had an economist who said the solution to U.S. agriculture is if the bottom 10% of farmers were no longer farming. That seems a pretty draconian response, but I'd love to hear your thoughts.
Well, I mean, when you look at agriculture today, and again, commercial agriculture, we are rapidly approaching the point where 80% of the production is going to be done by 10% of the farmers. So, getting rid of 10% doesn't really do much. And so I think we have to parse this a little bit in terms of, are you talking about commercial farmers? Are you talking about farmers that have good off-farm jobs? Are you talking about niche farmers and so forth? I don't think that's the answer. I think the answer is, producers have to get more efficient. I will always remember in the 1980s and talking with farm groups during that particularly difficult time, and one producer said, what can I do? I mean, this is tough times. And I said, well, one thing you need to do is find your wife a better off-farm job to start with. And so I think part of this is diversifying your income and so forth, particularly for the small producers and so forth, because this new technology is not scalable to them. When you're talking about GPS and you're talking about data mining and you're talking about all of these things, that doesn't really fit into the small producers. The small producer is going to be much more adaptive, and very often they're there for a lifestyle choice, not necessarily from an economic stand. So I think that's the other thing to recognize. For a lot of producers, they're not there to get rich necessarily. They really want that lifestyle of rural America. And what they want is enough profitability that they can raise their family and get them educated, et cetera. They don't need to build millions and millions of estate value and so forth. And so sometimes you just have to come back to the expectations, bring expectations into line. And I know I grew up in Washington State, and I, for a lot of wheat producers there, and I used to give them a hard time because I said, look, you only farm 2 months out of the year. This is a pretty good gig. Well, and most of them had teaching jobs. They were, they really taught at the local high school and so forth. So they tended to have a much more diversified income base, perhaps, than they do now. And I worry particularly about those producers that rent a lot of ground, don't have a lot of assets behind them. For this transition, this is a difficult transition if you don't have assets behind you. So if you've committed to renting a lot of ground and so forth, and what you have basically is equipment, this will be a challenging period. And I think those are the producers that are probably going to have the most assistance going forward. But I'm never an advocate of, well, let's just get rid of 10% of the farmers. This is very consolidated at this point. Yes?
Hi, so you mentioned that the baby boomers don't want to eat a huge steak anymore, and I feel like a lot of us don't. And so thinking about that, there's a lot of changes in people's eating habits, and it feels like on the farming side, there's a way of life that is feeling like resistant and protective of that. And I feel like the industries that are most successful kind of get ahead of trends, and the farming community seems like just more reactive, like, okay, now we really have to change, and we'll do some cage-free eggs and things like that. And so I was just wondering what your perspective is on that. Like, I feel like it would be more advantageous, and maybe there's a lot of resistance to it, but getting ahead of the trends seems to me a better business model.
Yes. No, and I think, from a lender standpoint, that's exactly where you want the producer to go. We have a lot of debates about animal welfare. You go down the list of issues that producers have to deal with, and the reality is they're going to have to adapt to that. The meatless meat is one of those things on the horizon that everybody's kind of not paying attention to. But I can tell you from the standpoint of an emerging market, if you wanted to feed your population with meat, that may be a better alternative than the kind of the traditional one. So it's why I say the technology over the next 10 years is going to dramatically shift what's going to be happening with regard to food production, where we consume it, how we consume it. We're going to Amazon the whole food and agriculture supply chain. And so you're right. I think in a lot of conversations that we have within the bank is talking about where are these industries going. Are they going to be able to find these export markets? Where are the competing products that are going to be coming on that'll be change the dynamics? And certainly baby boomers versus millennials or Generation X, you can see a different transition with regard to dietary preferences. And in many cases, you're seeing producers adapt to that. Organic milk, the recognition that the marketplace is changing. But that's not an easy transition to go from, from that traditional dairy herd to a dairy herd that's going to be producing organic milk and so forth. But yeah, you're quite right. I think we have to identify which are niche markets and which are real changes and trends.
Thank you.
Thank you. I think we're done. Thank you very much.